Understanding personal service corporations, structure, benefits, and compliance. A personal service corporation, PSC, is a specialized corporate structure primarily catering to professionals who provide personal services to individuals or groups. The Internal Revenue Service, IRS, outlines specific conditions and benefits that govern these entities, making them a favored option for many professionals such as accountants, lawyers, engineers, and other consultants. This article delves deeper into what PSCs are, how they operate, their benefits and drawbacks, and how they differ from other corporate structures like S corporations. What is a personal service corporation? The PSC is a unique entity created explicitly for the delivery of personal services. These services cover specialties such as accounting, engineering, architecture, consulting, actuarial science, law, performing arts, health services, including veterinary care. However, it's critical to note that financial services are generally excluded, leading many financial advisors to opt for S corporations instead. Key characteristics. Taxation. Personal service corporations are taxed similarly to C corporations at a flat rate of 21%. This corporate tax classification allows for specific tax benefits and deductions unique to corporate structures. Ownership. Employee owners must perform at least 20% of the services provided and collectively hold more than 10% of the outstanding stock in the corporation by the end of a one-year testing period. How a personal service corporation functions. For a corporation to qualify as a PSC, significant participation from the owners in the services offered is essential. Specifically, service hours. Owners must account for a minimum of 20% of total service hours. For instance, in a corporation with 5,000 annual service hours, owner employees must contribute at least 1,000 hours collectively. Income requirement. Employees of a PSC must dedicate at least 95% of their time to providing qualified services, ensuring a commitment to the services offered. Tax regulations and compliance. Organi PSC is subject to rigorous IRS regulations, ensuring full compliance with tax laws. For example, tax obligations include utilizing a fiscal year aligned with the calendar year, abiding by specific passive activity regulations. Failure to adhere to these guidelines could lead to penalties, audits, or disqualification of the PSC status. Exploring the benefits of a personal service corporation. Operating as a personal service corporation provides several advantages. 1. Tax savings. PSTs can take advantage of lower corporate tax rates, 21%, compared to the potentially higher personal income tax rates. This structure allows for strategic tax planning where owners can retain earnings and lower their personal tax burden. 2. Limited liability protection. The PSC structure safeguards the personal assets of its owners from business liabilities, protecting them in case of lawsuits or debts incurred by the corporation. 3. Access to corporate deductions. PSC owners can access certain tax deductions, including business expenses, employee benefits, capital expenditures. 4. Fringe benefits. Employee owners can benefit from tax-free fringe benefits, such as retirement plans and health insurance. Weighing the drawbacks of a personal service corporation. Despite the benefits, there are notable drawbacks to consider. 1. Cost and complexity. Establishing a PSC requires a thorough understanding of tax laws and ongoing compliance, making it more complex than simpler business structures. Legal and accounting fees can add significant costs. 2. Rigidity in structure. The PSC structure is less flexible than partnerships or S corporations, which may limit how owners can share profits or manage the business. 3. IRS scrutiny. Due to the specific requirements and potential for abuse, personal service corporations face a heightened risk of IRS audits. Non-compliance can lead to severe penalties. Distinguishing Personal Service Corporation from S Corporation. While both PSCs and S corporations serve specific professional needs, they differ in various aspects. Taxation. S corporations are pass-through entities, allowing income to be reported on the owner's personal tax returns. In contrast, PSCs are taxed at the corporate level. Shareholder limits. S corporations limit the number and type of shareholders, while PSCs focus on service provision and are not subject to the same restrictions. Ownership structure. S corporations generally allow for non-resident shareholders, whereas PSCs necessitate substantial ownership by individuals providing the services. Conclusion. A personal service corporation can serve as a strategic structure for professionals in fields such as accounting and consulting, offering a blend of taxation benefits, liability protection, and tax deductions. However, the complexity and compliance requirements associated with PSCs require careful consideration and planning. Prospective business owners should evaluate their specific circumstances and consult with tax professionals to determine if this structure fits their business goals and financial plans.